Mike, good to see you today. And
Good to see you, Jim.
looks like sunny Florida is treating you well.
I can't complain.
We are not so well here in St. Louis with a little bit of rain, and we've got a good number that have joined us today, and we will hang on as they continue to come on board. Let's see. Oh, we have people coming on right and left. That is good. Good to see. Oh, there we go. We've got here's some familiar names. David Adams, I think I'm seeing you later this week. Didn't you refer me to David Adams,
Oh, maybe.
the Medicare guy? I can see you on David. Let's see. Oh, here's people popping on right and left. We will give it a few minutes to let people join. And let's see. Very excited today. We've got about half of our attendees. We will see if we can wait a few minutes more. Or, Mike, we've got so much to talk about. I'm going to go ahead and get started because,
Okay.
uh, Mike, we do, and for those of you that are on already, this is participatory. So feel free to use the chat box or raise your hand if you have a question to add. We will be addressing questions towards the end. And if you have a good one, I'll pull you in. But we're going to be talking about long-term care, the real importance of planning for long-term care, because most people treat it like a risk, and I hope it never happens to me. Mike is an expert in this field. Mike, how long have we known each other? It's been 5, 6 years.
Longer than that. I think I first sat in your office probably in 2013 or 14.
Okay, so it has been more than that.
Yeah.
And I wish I had known you twice as long as I've known you because you bailed me out of a big problem. And that's probably a good place to start. But Mike specializes in long-term care. What I love most about Mike is that Mike does it from a planning perspective. I will start out with a personal story that happened with my own long-term care. First bought some 20 years ago, and then I was a bit younger and easily could afford it. I bought just plain long-term care coverage that we knew would go up, but we picked a great A+ carrier. And I doing well financially. So I thought I'm going to get $10,000 a month. That was the highest we thought 20 years ago that it could. I was smart enough to also get a rider for inflation and knew that prices could go up, but knew I was locked into a group and thought the good company would be my protection. Well, Mike came in to save us when later prices kept escalating on those policies. And what we ended up with was a company that was losing its rating. It went from an A+ carrier rating to a C, sold out to private equity. And I won't name that company, but it was shocking to see the degradation of that company. And our prices, my wife and I thinking, oh, we can afford this. I know we were paying about $6,000 a year for both of us. and had over $10,000 a month tax-free coverage for each of us. We thought we were smart with all that. With the inflation rider, it had grown to about $17,000 a month. However, the premium had grown from $6,000 a year to over $20,000. So, any of you that are listening may be aware, or you should be aware, that the costs of long term care with our aging society is going through the roof. At any rate, Mike really bailed us out with showing us an alternative in a lifetime plan. At first, realizing how much long-term care coverage do we need. My wife and I did a personal assessment that Mike, I love that first time I had seen it, not just how much do you think you need and you can afford it, to, oh, given our family history, here's what this shows stats. And again, it's an average thing, but this is what stats are. Was able to see that I actually needed or need to plan for on average about 400,000 for my own, about 400,000 for my wife. So there's a total of about an $800,000 need. And here I am at the point where my premiums have grown to $20,000 a year, no end in sight, the company going south, and me realizing, holy smokes, this is not going to last me. I'm not going to be able to afford this thing because of the expectation of continued increases. Any rate, was able to switch over to a 10-year policy for about that same $20,000. So for $200,000, I have over $800,000 of coverage. And Mike, thank you again for saving me and a number of clients. So Mike, talk to us first about why have the prices, why are things going up and the state of the industry for long-term care?
Yeah, I mean, the experience that you had with rate increases and things like that really boils down to three factors that consumers can look at and see. And that, number one was the prolonged interest rates that were so low for so long. Number two would be, the reality that the carriers were expecting a certain, what we call lapse ratio, people to take out a policy and then a certain percentage to allow those policies to go away. So, basically keeping all those premium dollars without paying any claims. And that ended up being a far lower ratio than expected. And then I like to just point out two names most people know about pretty easily, and that's Magic Johnson and Christopher Reeve. Magic Johnson was diagnosed in HIV positive in 1990, and Christopher Reeve fell off a horse and required LTC for 9 years in that chair full time. So those are two examples of lengthy claim history and things like that, and then just prolonged life and extending life as far as medical advancements go. So those are the reasons that I think people need to understand why the market, as far as the pricing, went up and what affected that so dramatically.
And no one would think Superman would need long-term care. So none of us like to think it's going to be us, but a very critical part of planning when you're looking at a financial plan. And Mike, what's your experience? How many people think about long-term care as a planning issue versus just an insurance to buy?
So I think one of the misnomers that we have, especially for a lot of consumers, is that the long-term care planning is looked at simply paying for the care. And how am I going to pay for it? When they're not really asking all of the right questions. What does care look like to them? What are their care preferences going to be? What is their legal, tax, and financial framework for their long-term care plan? So it really touches many different things that you work on with the consumer in the advisory capacity that you take. And, really it starts with, to me, having those conversations and being, very simplistic in how you approach it. Is it a Medicare coverage gap when they're turning 65? Is it, pre-retirees learning about what healthcare and retirement looks like? Is it, just an honest conversation about what finishes or completes a financial plan with respect to the long-term care component. And a lot of what I do or encourage there is to do what we call a halo assessment. And I'm just going to show a very brief piece of what the report looks like. But
Oh,
if
I
we can
love
think,
this, Mike, because as I mentioned in my story, this took me from thinking, how much do I need? Well, I can afford it. I want to get
right,
everything I can get to. You did this for me and my wife, and this is how much our family history says on average I need. Powerful,
right.
powerful
Well,
thing.
this is just a sample. This isn't yours per se, but when we look back over the years, this used to be what the industry used as far as averages. And I like to joke, whether it's with an advisor or with a consumer, that the average of one is one. So when we're talking to a consumer, we're talking to an advisor one on one, averages aren't very good, with respect to the individual. So when we can move away from discussions about averages, because there's no average retirement plan, there's no average estate plan. Everything that you do for a client is based on their particular needs. So when we go through the process and ask the right questions and learn about their lifestyle, family dynamics, and health history, and we're able to say, in this case, to Betty Boomer, that there's a 5-year expected need for care in today's dollars is going to cost about 400 grand, and most likely it's going to be 3 years of home health care, a year of assisted living, and a year of nursing home care. Now we basically have a simple question. It becomes a math question. In the event that you need care, when that care need comes, do you want to start today and segment $400,000 of assets? Or do you want to look at something that uses insurance and takes, pennies or nickels on the dollar to create that LTC plan for future use? And that becomes part of the question as far as what that plan begins to look like with respect to, as I mentioned before, what are the care preferences? Where do they want to receive care? Who's going to provide that care? Have they visited facilities? Things like that. So it really becomes a very holistic approach to what you do with clients, Jim.
Again, I really appreciate, and I want to highlight something. You mentioned asking the right questions. Again, long ago in the industry, I knew long-term care was a big risk. And as the baby boomers aged, I knew, okay, this is a greater and greater risk, and retirement communities started popping up. We shifted from the old nursing home kind of image to retirement communities and the need for skill or assisted care and how expensive that can get. So the risk was one of the things you shocked me with. Far greater risk than your house burning down, far greater risk than your car getting into an accident. And yet, how many people actually get, do you know that number, Mike? How many people actually have
So
coverage?
there are a number of really
Protect that
good
risk.
good surveys I can share with you and some of the industry participants have done that, but it's safe to say that about less than 20% of Americans have a long-term care plan currently. So at least an insurance-based plan. So when clients stand up or put their hand up and say, hey, I'm just going to self-fund this risk, that again addresses the pay for, not the plan for aspect of long-term care planning. So, when you sit there and you're sitting across from a client and they say, this isn't really in the discussion I want to talk about. I've got plenty of money. I can handle it on my own. My first response is handle what? Very simply, handle what? What does long-term care mean to you? And when a client sits there and says, well, I'm not really sure. I just, grandpa went into a nursing home. I said, well, okay, why did he go into a nursing home? Well, he was just old. Well, then it's getting into talking about what activities of daily living are, and, going through the very simple steps of saying you did all six before this, before 8:30 this morning, or there's a cognitive impairment, and that's the type of care that's required to maintain one's lifestyle, excuse me. And it's not so much a financial discussion, and there's been, you can do it many different ways. I'm sure you've sat in your conference room with clients, and the husband's kind of like sitting back like this, kind of having that, I don't really want to have that discussion. And I've been in those meetings and I've looked at the husband and I go, I want to do something here. And he's about 6'3" and about 240. And she's about 5'3" and about a buck 50, maybe soaking wet. And I say, I want you to go ahead and lay down here on the floor. And I want your wife to pick you up and put you back in your seat. And as soon as she does that without any help from you, our conversation is over. We don't have to talk about this anymore. And that's the reality check that many consumers need to see is that, is it something simple like that or something, a little bit more graphic, talking about adult diapers and toileting and showering and all of the things that go with the need for care. So
Yeah, certainly
I'm just
not
here to
something we want
support.
to talk about. Oh, here's a good question from Bob. Yes, and this is a highlight I'll offer to send out to everybody. By the way, we will, in everyone that attended, we're going to send you out a copy of this. And I'm going to include, this is 20 questions that Trinity asks the individual about long-term care and whether and what the best way for you to fund this in your retirement picture is. This is a tool that we use, and Mike, I think you pioneered it for us. So some great questions on how are you going to afford this? What level of care, what type of care, what are the risks, what are the tax advantages, all of that kind of thing. So Bob, I will include those 20 questions out with a copy. I think I can do that with a copy of today's webinar. But let me shift gears with you, Mike, to kind of some personal experience. You began to tell about how people don't like talking about this. We often worry about the stress and strain on the healthcare provider versus the person going in or needing the care, because it hits all of us from the blind side. And also, how temporary is this? We'd all rather stay in our home given that option. So we want that kind of flexibility. What's been your experience there, Mike?
Well, I think that's one of the big misperceptions about long-term care planning is that it's looking at what that need is for a nursing home, and only 20% of claims actually end up being in a nursing home setting. So what we're really looking at is, the adult daycare, the community-based care, the home health care, the assisted living facilities, the places that most individuals want that care to be delivered in. That's the first part. And that really goes along with the importance of the planning, because most people, or too many people, confuse Medicare and Medicaid, or think that Medicaid is an extension of Medicare, and that qualifying is some sort of automatic scenario, number one. And number two, the reality that the Medicaid delivery of healthcare is primarily the nursing home setting. So it's like they don't want to go to a nursing home, but they don't understand that the nursing home is all that Medicaid covers. So that's a big distinction to have with those conversations. Um,
Here's a
Another,
question by Don. How much can we count on Medicare paying for our long-term care? That's an easy one for you.
yeah, the only care that Medicare covers is going to be skilled nursing after an illness or injury or some sort of event that occurs, whether you're hospitalized or something like that. And it usually requires 3 overnight stays to be, admitted to the hospital. So, Don, if you have a relative or a loved one who's being in quote unquote under observation, that's bad. You want them admitted, because if you're not admitted for care, that Medicare skilled nursing benefit will not kick in, number one. Number two, that skilled nursing for Medicare purposes only lasts up to 100 days as far as what's covered. And there's some graduated costs that are involved there, that, what's covered and not covered. But after 100 days, either you're not getting better, or it's time to figure out what the next step is. And that's where traditional long-term care services kick in, because after 100 days of skilled nursing, you're not improving, and that's where it becomes chronic.
Yeah. Again, not something fun to talk about, but yet from a retirement planning, from a financial planning perspective, just a very integral part of holistic care. And I want you to speak briefly, Mike, to we deal with a lot of affluent folks. That's our primary market, and they can afford financially the risk of this. My net worth is sufficient, and therefore I self-insure. I just recently, just this week, had a client come in that's worth $10-12 million, and pays about $10,000 a year for her coverage. And she's like, "Do I really need this?" And Mike, what's your answer to that? I'll see how closely your answer
Yeah,
was to mine.
my response was that $10,000 you're paying for the annual premium, that could be 1 month of care, the way things are today. So it's really a bargain, number one. So if you've got the coverage and that's what you're paying for it, that's probably a pretty good situation to maintain. And I like to say that for me, it's one of those things, talking with consumers and their advisors and working through these issues. It's really asking some very basic questions. For the affluent individual that says, "I'm going to be self-funding," sometimes I just turn to them and go, "When did you cancel your homeowner's policy?" And they look at me like I'm crazy. Like, well, why would I cancel my homeowner's policy? And I say, well, where's your risk in retirement? Is it, like you said earlier, is it your home burning down? Is it, something like that? Or is there a bigger risk that you're going to have an event that, you lose your independence, you can't maintain your activities of daily living, or you develop a cognitive impairment? Where are those insurance dollars, if you will, best spent? And they never really equate risk and assessing that risk, number one. Number two, it's one of those things where for affluent individuals, it becomes a question of not really need as far as the dollars go, but the convenience of having that sort of plan.
And the tax-free factor, the leverage that comes with, getting tax-free monthly,
Right.
that factor that none of us want to plan on that cost, or needing our kids to step in and pay that. I think we're all deathly afraid of that.
Yeah, there's a concept that is kind of thrown around, and I've kind of repeated it to you, but it's called the silver tsunami. And if people don't recognize that, it's the graying of America, or an age wave that we're seeing as far as the boomers, retiring. And the first boomer turns 80 in less than 2 years, and the last boomer turns 65 in less than 2 years. And as those 75 million Americans go through retirement and into retirement, there's going to be changes that occur with respect to the delivery of healthcare. And one of the things that I always say about long-term care plans, especially insurance-based long-term care plans, is that at some point they may become your ticket to access care and not just pay for it. I mean, what's the first one or two questions that you get asked when you walk into your doctor's office?
Who's your insurance company?
May I see your insurance card? I mean, does anyone not think that that's a significant thing that could occur in the future? I mean, if you pick up the phone and call, ABC Home Healthcare, and they say, "Who's your insurance provider?" Why are they asking you that? Not that they don't think you can pay for it, but they want to be able to know that they're going to get paid. And having an insurance carrier with benefits that can be managed and verified, that's different. So, you have to look at that as one of the reasons. And when you talk about your affluent clients, having wealth doesn't guarantee access to healthcare. It guarantees access to be able to pay for it. But if 75 million Americans go through the system, and a large number of them are going to need care as they get older, it may be nice to have an insurance company in your back pocket to be part of that plan.
Here's a good question, Mike, that David is asking. I love the concept of plan for versus pay for. When's the best time to start planning for long-term care?
So there's a trick
Yesterday?
question I love. There's a trick question I love to ask, especially people my age in their 50s, and it's like, Jim, when did you start having when did healthcare and retirement begin to be part of your retirement plan? And most people are like, well, that's what we're talking about today. And my next question is, when did you get your first paycheck? It's kind of silly, but when you look back at your first paycheck, that was when your first Medicare, you know, your first Medicare deduction was taken out of your paycheck to go to start begin paying for, quote unquote, healthcare and retirement. So I would say as in the 50s when it becomes more important when the kids are starting to get off the payroll and they're going to college or out of college, and there's some income or some dollars freed up to begin planning for other things and get serious about that long-term care need in the future. I think that 55 number right where I'm at seems to be a pretty good sweet spot.
Well, and that's where you get into leverageable tax advantaged opportunities with coverage versus self-insure. And so not quite your first paycheck, but certainly when you get to this point where you're starting to realize your maybe lack of immortality that all of us
Right.
get to. I know what we here at Trinity like to tell people is there's 3 seasons in life that you go through. 20 to 40 is usually figuring it out. That season where you're kind of finding the perfect spouse to enjoy life with, the house, the kids, the job, all of those things. Then it's accumulating. 40 to 60 is where you're kind of bankrolling money to kind of say, hey, if I prepare well, I can last myself into the future with what I've earned today. I know more athletes don't quite have that luxury, but the third season is really when you've reached that point in life at 60 and you're looking at legacy, and nobody thinks of legacy as, oh, I want to be able to provide for myself healthcare wise. The beauty being that by thinking ahead, even if it's an uncomfortable subject, it's a whole lot easier to afford by using some of those uh, sometimes old insurance. Talk about that a little bit, Mike. I know you've uncovered a few situations in our client situation where they've taken old insurance policies or even annuities that they
Right.
bought from someone else and turned it into something that could provide a long-term care coverage with a leveraged tax advantaged benefit.
Yeah, there's a piece of the tax code that we go back to that was part of the Pension Protection Act of 2006. And in 2010, aspects of that legislation kicked in with respect to annuities and life insurance, which allowed what we call a 1035 exchange, or a like for like exchange from either a life insurance policy to an annuity or an annuity to an annuity. And it did some interesting things. And when you talk about your client who had $100,000 CD come due at Commerce Bank, and they bought an annuity, and today it's worth $150,000, and you ask that, or maybe $200,000, and you ask that client, how would they pay for care if they needed it? They say, well, I have this annuity that I'm just kind of keeping on the side. And you explain LIFO, last in, first out accounting, and how the Pension Protection Act can do some interesting things and turn potentially that $200,000 annuity into, four, five, $600,000 of long-term care benefits. And oh, by the way, all those dollars come out tax-free, if and when you pay for care. So there's some
Versus
things that we can,
taxable. Oh,
right.
it's a
So,
wonderful
and
leverage.
and we can do some of those things for people who might think that they're too old to even get a long-term care plan, because we can do some of those plans well into people's 80s.
Yeah, speak to that, Mike, because I know a lot of times I know you helped me in a situation with a client who now they're older. Companies have changed the whole process of going about this. What are some of the nifty things that you can use with qualified plan money and like creating coverage that has both the tax advantaged income or non-taxable income with the leverage of a much greater benefit should you need it there?
Yeah, a lot of clients when they ask how they'd pay for care are going to tell you that they'd have to take money out of a qualified plan, IRA, 401k, SEP, simple, whatever that might be. And if they're 65 or 70 and looking at beginning to take required minimum distributions, not too far off in the future, those are dollars that have to come out of their retirement accounts one way or another. So basically moving those from the left pocket to the right pocket and creating a long-term care plan, an insurance-based long-term care plan with some of those dollars is a very effective way to do it because now you're turning, dollars that have to come out and get distributed and taxed into tax-free benefits in the future if they need it for care. And the flip side of that is if you combine that with a discussion about legacy planning or estate planning and potentially doing some of those things with a hybrid life solution or something like that. Now you're talking about ensuring that those dollars coming out, even if they're taxed from a qualified plan, are going into a product that's going to have a tax-free death benefit for beneficiaries or heirs if that those dollars aren't used to pay for care.
So not only are you leveraging the income, but if you took it out of the qualified plan, you'd have to pay taxes on it. Versus if it's coming out in a long-term care policy, then it's tax free. But you also
Well,
that's
Uncle Sam's gonna get that distribution tax no matter what. The key is, where are those dollars going to sit and wait to pay for care in the future. And if they're gonna just be sitting if your client then is going to pay $1 for every dollar of care, that's not a great place. But if you can take that dollar and put it into from the left pocket to the right pocket and create a scenario where they're paying 40 or 50 cents for every dollar of care, or a death benefit's getting paid out to their beneficiaries or heirs, that provides a really nice way to create that long-term care plan, even for an older client.
Yep, you did that for us with someone that was had CHF and was on oxygen, so couldn't get a policy, but was able to convert something that was an old annuity they had gotten ages ago into something that
Yep.
had that nice benefit and create a nice tax lever on that. The other thing that I want you to mention, I think you've kind of talked about here, is these policy what I absolutely hated about my old long-term care coverage was that it's kind of like I'm betting on needing this. I have coverage, so if I go in, it pays off, but if I don't go in, I get nothing back. So it's kind of like I win or I lose. This is a win or lose situation versus this new kind of planning with all the leverage that it has gives you the ability. I know what my wife and I loved about, creating the coverage for, again, in our situation, it was about 850,000 of potential need for both of us. It's going to cost us over 10 years, about 200,000. But if we don't need it, we get it back through you mentioned hybrid policy. Explain that a bit, Mike.
So one of the things that happened, and I guess the policies started to become were created in the late '80s, is there's a lot of consternation, if you will, for people to look at exactly what you're talking about paying a premium for really something that they don't really want to have to use. And then that's one of those things where, insurance becomes kind of a very difficult discussion. So if it becomes a discussion or a concern with a client who doesn't like the idea of potentially not being able to have those dollars around if they don't use it for care, then you kind of move the discussion to potentially one of the hybrid solutions that's built on the back of a life insurance policy or an annuity. And that really gives you the opportunity to have a discussion about live, quit, or die. If you live and you need care, it has long-term care benefits. If you pass away and you don't use it all for care or none of it for care, you're going to have a death benefit coming back to your estate. And there's a cash value component. So if you at some point in the future decide you didn't want the policy, some or all of that cash could be returned to you. So it maintains flexibility. So what I like to say is that there are a number of things that drive the discussion with respect to insurance-based long-term care planning. People deciding how they want to fund the plan is one of the drivers of that discussion. And really the benefits that they want, how they want those benefits to be paid out in the future, how they want that product to be designed. But if you have someone that's got a $100,000 sitting in an old annuity that they can create a long-term care plan with, you're not going to, most likely you're not going to start liquidating that to buy a traditional long-term care insurance, because it just doesn't make that much sense. But if you've got all that leverage with respect to taxable dollars and gains and things like that, and the ability to turn $100,000 into $200,000 or $300,000 of LTC benefits, that becomes that lever point, or that use of the tax code that makes it a very easy transition for clients to look at and say, well, I'm not spending the money, I'm just moving it again from pocket A to pocket B.
I know that was the example of that client. We at Trinity, we don't do a lot of annuities. We usually see them in clients' portfolios when we get them. Kind of a commission-driven, expensive thing. But in this case, this was the only way the client could get the coverage because of their age, because of their current health status. And it just made tremendous sense. In their situation, I recall he could get the coverage, but she could not. And this was just a terrific way to get that coverage.
An interesting discussion about annuities, whether they're for long-term care planning purposes or retirement planning purposes. A great question to ask a client is, what came first, the annuity or their stock certificate? Because the annuity goes actually back to the Roman times, and it was how they would pay the soldiers, and I believe it's called an annua. Is how it is the derivation of the beginning of the word annuity. So, there may be people that hate annuities today, but they've been around for about 2,000 years.
Yep. And this is one example where we've seen being able to use that was possibly intended for something else, but for something that comes into a planning mode for covering that risk in a very advantageous way.
Right.
Mike, what else is important that you see a lot in the industry that most people struggle with in terms of coming to grips with paying for long-term care?
I think the biggest thing today is just recognizing the need to plan for it. Again, it goes back to what I said earlier. It's the plan for versus pay for. That knowing what you're planning for is important. So, if you're, most of the people that you're talking to are in the St. Louis area, and, maybe they live in West County, drive around and see all the facilities that have been built in the last 2, 3, 4, 5 years. Make an appointment. Yeah, make an appointment and go see some of those facilities. And down here in Florida, we have an industry that's basically based on placement services. It's help people who help other people find home health care and assisted living facilities and nursing homes and things like that. That help them do that homework and that research. And it's a huge industry down here. And there's some people in St. Louis that do that, but talk to a home health care provider, because the last thing that you want to do when you're faced with the need for care for a loved one is being in crisis mode, as opposed to, well, we talked about this with Dad 4 or 5 years ago, and we want to use, XYZ home healthcare service because they're awesome, whatever it might be. And being able to pull that information out of that, you know, one of the things that we encourage is actually to have a long-term care plan document. I mean, that's really what it boils down to is, and I'll actually show you kind of what that looks like a little bit. And this is just a sample, kind of a template of what the document might look like. Let's see here.
I want to also, there's a question here about that personal need. The great question, John. The how do you figure out that personal need for your family situation? For any of you on this webinar that would like to go through that, we've got a short questionnaire that we're happy to send you. So let me know that you're interested in that and be happy to walk through what your family history, it's what 20 questions that you answer about your family history for you and your wife. It's often different. I know it was in our family. And that allows us to look at what, again, on the average, and we stress here at Trinity, personalized planning. It's very different for each person. If you've got lots of family members and they are kind of part of your picture, great. If you don't want to be dependent on, everyone's a little different. And that's why we say we go pretty deep with figuring out what the individual situation is for you. Go ahead, Mike.
But yeah, imagine if you were sitting down and you're saying, okay, what does a long-term care plan look like, as opposed to just getting down here and saying, how am I going to pay for it? What's the funding strategy? It's going through and knowing, what you want, what your preferred living arrangements are, your preferences and directives, where your financial information is coming from, a caregiver support plan, tax, legal, and estate planning consideration, any other resources or contacts that are important to the process. And then, as because you meet with clients on an annual basis, is what's the review and revision process? What might affect this change, or what might need to be changed as a client goes through. So when you look at this 10-point plan as being an outline for, long-term care planning, there's also a plan document questionnaire that we can provide, that you can use to actually go through and answer these questions, that allows the individual or you as the advisor, Jim, to really help the client figure out what this actually looks like, as a plan document. And one of the things that I say a lot today is that, especially for clients who are looking at long-term care planning, is put it in writing. Don't make your family or your kids or your, whoever guess what you want when you can't tell them what you want.
Good point. I know this being proactive, everybody likes the idea of proactive. The example I always use with tax planning that hits people in the face every year is it's too late after December 31st to plan on what you could have done last year tax-wise. Well, with long-term care, what age do you start? It's never too late. Yesterday is the right answer. However, looking at what the options are, those do change. And I love that point about the annual review, or we typically do it every 2 to 3 years to keep from, if you were with us at the top of the hour, facing that situation that my wife and I faced, where the price kept creeping up over a 20-year period. And again, it didn't seem so bad when it went from $6,000 to $7,000 a year for us, and then $7,000 to $9,000. Oh, I guess we'll still, over a period of 20 years, we didn't really think about it until it was like, wow, we have got to do something about this. And Mike, that notion of having a written plan that addresses this is a good one.
Yeah, I mean, I would encourage any consumer to look at long-term care as a component of many other types of planning, whether it's a retirement plan, an estate plan, tax planning, risk management planning, whatever it is. The long-term care piece is a component of that comprehensive planning. And I would flip that around and say, quite honestly, as an advisor, I think you'll agree with this, that what do you call a financial plan without a long-term care component? I call it fiction.
Well, and I want to point out, as times change, a humorous story that I had happened to me. I had a very wealthy, big name, big St. Louis name family that were clients of ours for over 30 years. They had gone to a seminar in Florida, Mike, and heard someone, could have been you speaking, but in any event, they came back with this, Jim, how come we don't have long-term care? And I said, well, you always thought your net worth was sufficient. You thought, you could afford it. In fact, in this family's case, they were convinced that they would spend less money going into a assisted than not. So that had always been the answer. Well, apparently someone had talked to them, and they spent in one single premium payment, I think it was $280,000, to provide a one-time payment that would cover them for their life, and was a very much of a peace of mind comfort provider when he ended up about 2 years later undergoing some serious health challenges, undergoing the risk of Parkinson's and so forth. So any event, all of these things are part of a living, breathing plan. I don't see any other questions. Let me see. So Mike, anything to wrap up with? Thank you for being here. And again, Mike,
you're welcome.
for
one of the
45 years, been in this industry and been an expert that has focused your practice very much specifically in the long-term care field. Thank you for what you do for our industry.
You're welcome.
Anything to add, Mike, before we sign off?
The only thing that I was going to say is I'll send you a link for anyone who wants to do a Halo assessment, and just make sure that they let you know that they're going to do it, because that report will come to me, and then I'll forward it to the email address that's provided.
Happy to do that. So please. And this was a perfect segue. I know our last webinar was Aging in Place, where we talked about Tim Vasi, a guy in the St. Louis area that's known for helping people figure out how do you stay in your home if you don't want to move into a retirement community, and how do you prepare for when you do? So long-term care being a great segue. I know I've had a number of people ask about Medicare and how to handle that, so we may do a future one. Please send us your ideas and thoughts, and we'll do a future webinar on that. Thank you for joining us, and I'll look forward to talking to you next month. We'll have another one.
Thanks, Jim.
All righty. Talk to you then.
All right. Bye-bye.
Bye.